Today in this lecture we are going to learn how we are going to value the equity shares based on the earnings. Now till now whatever we have learned that the equity shares are valued on the basis of dividend also. So if you will go through the previous lecture series or you can say previous videos, you will see that dividends are also divided into constant dividend when the company is paying the constant dividend or the company is paying the variable dividend. That means the dividend amount is changing. Plus I have also explained when the dividend is changing, there can be the constant growth rate. That means every year the company's dividend is increasing by the fixed percentage, or there can be the variable dividend also. That means the growth rate is changing every year. So we have already discussed how we are going to value the equity share. In this lecture, we are going to learn how the valuation is done on the basis of earnings. So previously we have learned that dividend is paid every year and the dividend is paid till infinity. So how we are going to value it? So whenever we are talking about that the valuation is based on earnings, so first of all the question arises, what do you mean by word earnings? Now over here earning means that what the company is getting, or you can say what the company is earning by investing the amount. Whenever you start the company, you invest the amount either by way of shares or by way of debentures, you borrow the money, or by any source you borrow the money, and then you are going to invest the money in the business. So earnings means whatever the company is earning per share. Now let's see, first of all let's see how we are going to calculate the earnings for the company. Before that, just a small introduction that whatever we are saying the valuation is based on earnings, we also named it as price earning ratio. Now, price earning ratio, this is your price earning ratio approach, or we can say earning multiplier approach. Now we will be discussing why we are saying it is an earning multiplier approach or price earning ratio approach. Now, before moving to this part that the price earning ratio is a ratio between the price of a share and its EPS, we are going to discuss this later on. First of all, let's see what you mean by word earnings. Now, if we talk about earnings, the first thing is that earnings means that first of all, whatever amount we are going to calculate it in the business. So if we see the amount that we are going to calculate in business is known as profit before interest and tax. Or if I move before this we can say whenever we are selling the product in the market. So the first thing is your sales. From sales you are going to subtract your cost, maybe your variable cost, maybe your fixed cost that is related to your business. And after subtracting the cost, we get the answer to be profit before interest and tax. Now from this profit, we are going to subtract the interest first. Interest over here means if we have taken loan, if we have taken your debentures, if we have borrowed the money by way of bonds. By whatever source we have borrowed the money on which we have to pay the fixed rate of interest. And these rate of interest is irrespective of profit you are earning. Suppose you are taking loan from the bank and you have to pay 10% interest. So bank will not see whether your earning capacity is there or not, whether your business is running or not, or whether you are having a salary or not. You have to pay the fixed rate of interest irrespective of amount you earn. So from the profit, first of all, we are going to subtract the interest on debt. Once we have subtracted the interest on debt, we are going to get profit before tax. Now, profit before tax means now from this profit, I have to pay the tax to the government. So whatever the tax is levied by the government, we are going to subtract it. And the government levied tax by way of percentage. If let's say government is saying that you have to pay 50% of your earnings. So whatever profit is there before tax, you have to calculate 50% from that. You have to pay that 50% to the government. Now whatever amount is left, that is known as profit after tax, or in some books you will get it's named as EAT, earning after tax. Now we can also borrow the money by way of preference dividend, preference shares. So now whenever we are borrowing by money from the preference shares, we have to pay the preference dividend also. Now from this profit, whatever profit we are left after paying tax to the government or after paying interest to the on the debt, we have to pay the dividend to the shareholders. Now once we have paid the dividend to the shareholders, we are left with equity shareholders fund. Now this is the fund that belongs to the shareholders. Now earning means what the company is earning by investing the amount of one share. Now what I have to do from this, I have to subdivide the outstanding equity share. That means whatever the shares the company is holding, I have to subtract that from this. I have to divide that amount from this equity shareholders fund, and I am going to get the earning per share. So this is my earning. So that means whenever we are talking about the valuation of equity shares which are based on earnings, we are talking about EPS. EPS is nothing but what the company is earning by investing the amount of one share. So whatever answer I am getting this earning by one share. So I'll be considering about the one share earning, because whenever we are going to value the equity share, we are not going to value the equity share for the whole company. We are going to value the equity share for one shares only. So that's why we are calculating its earning per share. Now let's come back to our previous slide. Now over here, the earning PE ratio, whatever we are saying, your value is based on earning. So price earning ratio. Price earning ratio says that whatever earning the company is having, that means that earning is to be distributed to the shareholder, but it's not a guarantee that the company will distribute the complete earnings to the shareholder. But yes, we can say that the company is earning this much of amount by investing the shareholders fund in the business. Now whenever we value the equity shares, we have to see that how much times the investor is ready to pay the amount in the open market of the EPS. That means P ratio is a number of times investor value earnings as expressed in the market price of a share. Let's say if I am saying the market price of a share is 100 rupees and the EPS is 10 rupees. So that means the investor is ready to pay 10 times of the earnings of the company. If company is earning only 10 rupees per share, but the investor is ready to pay 10 your value of share. So let's come to the formula for the value of the share. Value of the share is EPS multiplied by P ratio. So EPS is earning what the company is earning on one share, and P ratio means how many times the investor is ready to pay the amount for that earnings. Now whenever you will see the company's balance sheet, or you can say the company's financial, you will always see the P ratio. Now let's come to the example first, and after that I'll show you how the real market works for this. Now over here, let's see, we can say that calculate the value of equity shares when the equity share capital is rupees 20 each. That means one share is costing is rupees 20 and total value is 50 lakhs. Your reserves and surplus is 5 lakh and the company has borrowed 15% loan of 25 lakhs and 12%, 12.5% unsecured loan of 10 lakh. Company is having the fixed assets of 30 lakh and investment of 5 lakh. Company's operating profit is 25 lakh. That means your profit before interest and tax is 25 lakh. Tax rate is 50% and P ratio is 12.5. Now P ratio is 12.5. That means the investor is ready to pay 12.5 times of the earning. So first of all, let's calculate what do you mean by EPS, how to calculate the EPS. Now, profit before tax is 25 lakh and interest on secured and unsecured loan. If you will see, the secured loan is 15% of 25 lakh, which comes out to be 3.75 lakh, and 12.5% of unsecured loan is 1.25 lakh. So total is your 5 lakh. So 5 lakh we have paid for the debt and we are left with 20 lakh. Now the government tax is 50%, so you have to calculate 50% of 20 lakh, which is 10 lakh. So profit after tax is 10 lakh. Now in this we don't have to pay any preference shareholders dividend, so amount is nil. So equity shareholders fund is 10 lakh. And number of equity shares, if you are going to see, there is a value of 50 lakh and one share cost rupees 20. So number of equity shares we are having 2.5 lakh. And when you are going to divide 10 lakh by 2.5 lakh, your EPS is 4. So that means one share the EPS is rupees 4 per share. So if I am going to calculate the value will be your 12.5 times of 4 rupees, that is rupees 50. So value in the market is rupees 50. Now let's understand with the example. Now what I am going to take, I am going to take the FMCG companies. Now if you will see the FMCG companies, I have taken one is Hindustan Unilever, and if you will see the Hindustan Unilever, in this you can see that the price earning ratio is 55.08 and your EPS is 43.91. Now if we are going to multiply these two, okay, let's multiply these two. If you are going to multiply these two, your answer will be around 2, it will be between 2397. If you are going to multiply, so 55.08 multiplied by 43.91 comes out to be 2418. So that means it comes within this range. So in this for Hindustan Unilever, the investors are ready to pay 55 times of whatever the EPS is. Now if I am going to see for the Dabur, now you can see for the Dabur also, your price earning ratio, if I am going to see the price earning ratio over here is 53.04 and EPS is 10.13. That means investor is ready to pay 53 times of whatever is EPS. And if you will see, the range over here is 532.3 to 539. And if I am going to multiply these, it will be around 530 something. So P ratio is nothing but how many times the investor is going to pay off the EPS. Now how we are going to judge whether I should invest in company A or company B? Now you can compare the two different companies to see whether the P ratio is more or not. And if I am going to see Hindustan Unilever, the P ratio is your P ratio is 55 times, and in Dabur the P ratio is 53.53 times. So it's near about same because both are the FMCG companies. Even you can compare it with the sectorial P ratio. Sectorial P ratio means that in FMCG company, FMCG is one sector where the average of all the companies is taken and then we calculate the sectorial P ratio. Now if you will see, I'll just show you the sectorial P ratio. You can see this is for the Hindustan Unilever and sectorial PE is 61.77. And if I am going to see the sectorial PE for Dabur also, you can see it will be around, it's 61.77. So because Hindustan Unilever and Dabur both are under the FMCG company, so sectorial PE will be same. It's 61.77. You can compare from that also that whether the company is having a company is a good or bad. But it does not means that we can say that if the company's PE ratio is more, that company is better. If the company's PE ratio is bad, it's or you can say it's less, it's bad. It depends on the investor's choice. For example, if I'll take you one example, let's say I am the brand choosy person and some other person is not a brand choosy. If I'm always ready to purchase that particular brand, or let's say uh, I use the laptop, and where let's say I'm using the normal HP laptop and one person is using the Mac laptop, right? So the Mac is always be expensive than your normal HP. So if that we both have the same features, but still if I want to purchase a Mac and I'm ready to pay the more price for that, but I can work on the HP laptop also. So that means investor is ready to pay more price for that. Maybe all the features are same, so it does not gives you the guarantee, if it does not show you this part that the HP laptop is bad as compared to your Mac notebook. Both are at the same thing, but the thing is that investor is ready to pay. So your valuation depends on the P ratio, that means price earning ratio, and price earning ratio can be more or less. So now I think you it must be clear that how we are going to calculate the value of shares. Now I am having a one question for you. If you have understood the concept, please try to do this question. You have to calculate the valuation of equity shares when the companies have, and your one share is costing rupees 20, and your reserves and surplus are 7 lakh, 15% debentures are 25 lakh, 12.5% debentures are 10 lakh, fixed assets are 30 lakh, your investment is 5 lakh, operating profit is 25 lakh, 50% tax rate, and P ratio is 12.5. For further reference, you can refer my book on financial management. Thank you.